For the majority of 2022, most stock market investors have seen their portfolio dipping. In this market, investors are asking if they should sell their investments and get out with whatever they have left. Or should they take this bear market as an investment opportunity for future growth? The effect of inflation on the stock market has been severe. It has been soaring for many months, slowing economic growth. After calling persistent inflation transitory for many months, the Federal Reserve finally caught up to the uncontrollable inflation. Starting in March of 2022, the Federal Reserve started increasing the interest rates. Despite the regular interest rate hikes, the latest CPI report shows that inflation is still on the rise. So far, the Federal Reserve has raised interest rates 6 times, starting with 25 basis points back in March. The latest increase in interest rate was a 75 basis point increase in November 2022. These rate hikes are making borrowing money more expensive and slowing the growth of businesses across the board. Investors are in a state of panic, and as a result, the stock market has dropped for the majority of this year. Through the end of September, the S&P 500 index had dropped nearly 25%. Analysts predict that the stock market will fall another 10 to 20% through the first quarter of 2023. All of this is causing investors to be concerned, and the impact on the market is obvious. So what does this mean for you as an investor? Does it mean you should rush to your favorite online brokerage and buy the dip? Or would it be a better strategy to withdraw from the stock market entirely to avoid further losses? Following last year's roaring bull market, 2022 has been an especially frustrating year for investors. In 2021, the Federal Reserve was forced to intervene in the market's response to the pandemic through quantitative easing. Liquidity poured into the economy, and the interest rate was essentially set to zero. Although this causes the stock market to soar in 2021, the effect of excess liquidity in the economy is finally felt in 2022 as persistent inflation. To combat such high inflation, the Federal Reserve had to start raising interest rates and begin quantitative tightening. This frightened the market. Nearly all major indices and many individual stocks are down by double digits year to date, making many investors wary of putting more money into an already bleeding stock market. According to a May 2022 Bankrate survey, 56% of U.S. investors said they had purposefully avoided making investments due to stock market volatility. However, with inflation remaining high, and markets continuing to fall, investors may be even more hesitant to put their money to work. The market situation at the moment looks gloomy. The important question investors are asking is it the bottom? Or is the market going to drop even more? Although no one can answer that with certainty, according to several Wall Street experts, this is not the bottom of the market, and the price may continue to drop throughout early 2023. Which presents an excellent opportunity for investors to invest when stocks are cheap and ride the wave of growth back to the top. It is critical to remember that timing the market is extremely difficult. According to historical returns over the last 15 years, missing the market's 10 best days each year would have cut your returns in half. So, anticipating the market's fall, and predicting its rise, isn't the best strategy. On the other hand, putting your money to work in proven investments, and letting it work for you over time is the best way to go. Concentrate on what you have control over. The stock market will have its ups and downs. From 2016 to 2021, the percentage of stock market days up was 54.89%, while the percentage of days down was 45.14%. You cannot control the market. The only things you have control over are your financial goals and the strategy you're using to achieve them. If you're young and investing for a long-term goal such as retirement, which is decades away, you probably don't need to worry about the current downturn. However, if you have a short-term goal, such as purchasing a home, you should consider whether the investments you've set aside for that purpose are appropriate. On the other hand, if you're at or nearing your retirement age, navigating this market can be tricky. I have put together a separate video on retirement during a recession. If you want to learn how you should proceed as soon-to-be retirees into the upcoming downturn of our economy, and how you can maintain your retirement portfolio, please check out that video. One of the best ways to stay calm and invested during volatile times is to treat investment contributions like a recurring subscription, a technique known as dollar cost averaging. Rather than attempting to time the market, you invest a specific dollar amount at regular intervals, say once or twice a month, depending on your ability. You're buying in at different prices, which should average out over time. It reinforces the practice of investing on a regular basis in order to accumulate wealth over time. It eliminates the pitfalls of market timing, such as only purchasing when prices have already risen. It also removes emotion from your investing, and keeps you from potentially undermining your portfolio's returns. If you're enjoying this video so far, please subscribe for more content like this. Your support is greatly appreciated. So what about the other side of the coin? Should you pull out of this volatile market? Taking your money out of the market may appear to be the safest option. After all, if stock prices continue to fall, withdrawing your investments now could save you even more money. However, because the market has already fallen significantly, selling your stocks now may lock in your losses. Since its peak in early January, the S&P 500 has fallen more than 24%, while the tech-heavy Nasdaq has fallen more than 32%. If you withdraw your money now, you will almost certainly be selling your investments for much less than you paid for them. Furthermore, if you decide to reinvest after the market has stabilized, you may lose even more money. By investing after stock prices have recovered, you will be paying more for the same stocks that you just sold. The stock market may appear to be anything but secure right now. While it can be volatile in the short term, it has been extremely consistent in the long run. The market has seen many ups and downs, as well as some severe recessions, in the last 2 decades. The S&P 500, for example, fell nearly 50% when the dot-com bubble burst in the early 2000s. It fell by a staggering 57% during the Great Recession. Despite this, the S&P 500 has risen by more than 147% since 2000. While every downturn is unique, and no one knows how this one will end, the market is very likely to see positive average returns over time. For example, if you invest $1,000 per month, with a $10,000 initial investment, at a 7% average stock market return over 30 years, you will have $1.3 million under your portfolio. It is difficult to remain invested in the stock market during periods of volatility. However, it is one of the best ways to build long-term wealth. If market downturns teach us anything, it's that losing value is not the same as losing money. Your portfolio has most likely already lost value, and if stock prices continue to fall, the value of your investments may drop even further. However, unless you sell your stocks, you will not actually lose any money. If you stay invested until the market recovers, your portfolio should recover and you will not have lost anything. As an added bonus, if you continue to invest when stock prices are low, you may see significant returns when the market recovers. The key is to select long-term investments that are solid. Not all stocks will survive the downturn. However, if you build your portfolio with stocks from strong companies, you are far more likely to make money over time, even during a market downturn. So, if you're wondering if now is a good time to buy stocks, advisors say the answer is simple. Keep investing in strong companies, by dollar cost averaging, as long as you're planning to invest for the long term. The market will recover, and when it does, you will be grateful that you stayed invested. If you like this video, please leave a like and subscribe to the channel for more content like this. Until next time, stay safe.